Thanks for clicking! A Bank of Canada interest rate cut could light a match under the real estate market. This according to a recent article from the Globe and Mail.
I can make that happen.
Indeed, in the article from the Globe and Mail comes amid multiple reports telling us that the Bank of Canada is in the all clear to cut interest rates in June. And while the markets are still only pricing in a 46% chance of that happening, when a media that has shown itself to be either A, purposely deceitful, or B, illiterate, it's important that we take note.
A little from column A, a little from column B.
In all seriousness, though, we could very well see interest rate cuts coming from the Bank of Canada in June or July. And, as such, it's worth taking a closer look at the Globe's argument that FOMO could set in, that prices could skyrocket back upward once those rate cuts come to fruition. So what I want to do today is go over the Globe's article questioning whether or not FOMO will set in when the bank cuts rates, take a look at its historical comparison, as well as the comparison that is less ridiculous, and then go over the current real estate landscape heading into these rate decisions. While the media is pushing the narrative that a June rate cut is upon us, we will find out for sure next week at the June 5th rate announcement and subsequent press conference thereafter. We'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this article. On to the article in the Globe and Mail, which starts with the premise that the Bank of Canada could be cutting interest rates as early as June.
Everything's fine, I told you, bro.
Very true, and while the article does note that the move would bring at least some relief for those with variable rate mortgages, it says that the move could also make it tougher for those looking to buy a home, as a small drop in interest rates could have a big impact on the housing market. And to support this point that a small amount of rate drops could have a big impact on house prices, the article points to March of 2020, when the Bank of Canada dropped interest rates to 0.25%, which sent monthly sales up 57%. Further, prices went up by 17% by the end of 2020, with the average price ultimately peaking at $817K in February of 2022, before obviously dropping by $200,000 over the next year, and then recovering another $100,000 of those losses over the year after that. And while the article does note that a large portion of the price increases were merely psychological, with buyers seeing prices increase and then jumping into the market, therefore causing prices to increase, it then asks if the same psychological FOMO could happen this time around.
I'll take care of it.
Yeah, they're certainly trying, with nary a day going by, where we're not told that the Bank of Canada cutting rates is going to send prices to the moon. But is that the case? Will FOMO be set off the minute the Bank of Canada cuts rates? Well, first off, the choice of 2020 as a comparison is curious, to say the least, as even a brief look at the historical price data shows that something was quite out of the ordinary in 2020 and 2021. Those 2 years were obviously outliers, that is, data which lies at an abnormal distance from other values. Why would the Globe base its projections of the current real estate environment through a comparison where the central bank cut interest rates by 150 basis points within a matter of 3 weeks? The most rapid interest rate decreases that we have on record. The article makes the case that a small drop in interest rates can cause major price movements, and then uses the results of 150 basis points worth of rate cuts in 3 weeks as its comparison.
This is the class that people fail often.
So, instead of basing our conclusions off of an outlier, off of an aberration, off of something completely out of the norm, let's try to repeat a much more likely scenario, a rate cut or two, and see what happened with the housing market then. Thankfully, or not, we have one, and only one, example of non-emergency rate cuts over the past 15 years. As in 2015, the Bank of Canada did in fact cut rates twice, with the last one occurring in the summer of that year. So, when the bank made that final cut, totaling 50 basis points in 2015, did we see a major increase in sales activity that year? Not really. If we look at the year-over-year chart, sales activity continued to fall following the cut, shot up between December and April, and then moved back down to where it was the year prior. So, 50 basis points in rate cuts, with the final one occurring in July of 2015, didn't really do much for buyer demand. And that's it. That's all the non-emergency rate cut evidence we have over the past 15 years.
Everything's cool right now. Might be some problems later, but...
So, what does all this data tell us? Not a whole lot at first glance. It does give us a more accurate comparison than the Globe and Mail comparing now to 2020, a once-in-a-lifetime pandemic, but it doesn't tell us anything about the 2016 economy, affordability, or housing supply. So, let's set a good example, and we'll go over a proper comparison.
What the f is that?
Back in 2016, unemployment was running at 6.9, a bit higher than it is right now, and inflation was running at 1.2. So, the economy was relatively worse off than it is right now, though it's not clear how long that will hold, and people were probably less worried about inflation than they are right now. So, how about affordability? Well, just as a rough gauge, if we look at the Bank of Canada's Affordability Index, it was a lot easier to afford a home back in 2016 than it is right now, or than it was when we had 0% interest rates. So, the basic economics of being able to afford a home,
What the f is that?
the basic economics of being able to afford a home were much, much better in 2016. Yet we didn't see major demand come back to the market upon those rate cuts coming from the central bank. Which obviously brings us to supply. Where does Canada stand now in terms of supply compared to where we were back in 2016?
Way worse.
According to a widely cited report from Scotiabank, incorrect though it was, Canada had 427 units per 1,000 people in 2016, and as of 2020 had 424. As a side note, this led many to argue as late as September of 2023 that Canada had the lowest housing supply in the G7, even though this notion was debunked by BMO's Doug Porter back in 2022, noting that Canada's housing supply is not lower than the United States, which was backed up by the 2022 budget, showing that Canada did in fact have more homes available relative to population than the US. But I digress. The main point stemming from the Scotiabank study, flawed though it may be, is that between 2016 and 2020, Canada had a very similar amount of homes relative to its population. As for the most recent data, well, we don't really have much, with the most recent studies, including the one from the Macdonald-Laurier Institute, from the Fraser Institute, and of course the Globe and Mail in September of 2023, continuing to reference the incorrect point from Scotiabank that Canada has the lowest relative housing supply in the G7, which was just not the case. Now, surely the number of newcomers that have arrived in Canada over the past few years have obviously tightened Canada's housing supply, but the data on that is scant. And if we don't have the data, then no one else does either. Or at least if they have the data showing that housing supply has worsened to such an extent over the past 2 years, they're not citing it. So what does all this mean? Well, the last time the Bank of Canada cut rates by 50 basis points, we didn't see all that much demand come back to the market. And the economy was relatively similar to what it is now, maybe a little bit worse, and housing supply was relatively similar as well, at least according to the data that's currently available. However, back then, in 2016, affordability was much better, and Canadians didn't jump immediately back into the market en masse, even when it was easier to do so. Taken all together, the economic fundamentals say that we shouldn't see an immediate upsurge in market activity when the Bank of Canada cuts rates. However, as even the Globe and Mail notes, FOMO is a self-reinforcing prophecy. It's psychological, meaning that if Canadians think prices are going to go up, they may try to jump back into the market when we see rate cuts. If we do see an immediate bump in prices following those rate cuts, say within the first few months, then yeah, we could see Canadians pile into the market, to the extent that the basic economics allow them.
You need to make that happen.
But the mood of Canadians, the current psychology of Canadians, is not predictable. That's not what we're seeing in the data. That's very hard to pin down, and as such, we're making predictions about which we know nothing.
That's the spirit.
As we've gone over so many times on this channel, what Canadians are going to do is unknowable. We do not have data for this stuff. We don't have the data on the extent to which Canadians are buying the FOMO. The data you do have is what you can afford. What you can afford and what you're looking for in a home. If you want the home, consider buying it. If you don't, then don't buy it.
That was terrible advice. Terrible advice.
With that said, that highly anticipated Bank of Canada policy announcement is coming up next week, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.